So you think of how big this has gotten, and to hear like $1 billion in arrears, and you think, well, how big is $1 billion in terms of the debt in Canada? It's like, well, it's not very big at all.
Welcome to the Tom Storey Show with Steve Karrasch and Tom Storey, where we discuss everything real estate or whatever else is on our minds.
Let's go. Because I don't know if you don't know Rowan.
No.
Have I ever told you the story about how I met Rowan?
I have not heard it, no.
Okay.
Is this
good,
PG-13 or what's the...
Yeah. No.
Okay.
It's proper real estate talk. So my old partner, Chris, had a neighbor who was moving. And so we helped her move. And she's like, my nephew is a mortgage broker. So he's going to be working on the deal. And that person happened to be Rowan. And so we're both much younger and better looking in those days, and a little bit more hair. And Rowan did, so we did the deal. It was all fine. Everything was wonderful. It was one of, I want to say difficult. It might, well, I didn't notice it was difficult. But Rowan did the very typical thing afterwards, which is, younger age. I want to say it might have been one of my first deals with Chris on the team, or very early on anyway, within the first year. And Rowan did the thing after a deal's done. Any good younger broker looking for business phones up the agent and says, hey, can I get any more of your business? Let's go for coffee. So I think we met this is back when I used to drink Tim Hortons, when I hadn't quite elevated yet to
Where
Starbucks.
Are you at now? Oh, you're a Starbucks?
Where everyone is. Where you should be. Don't drink Tim Hortons.
If I had to guess, you know what? I got McDonald's coffee this morning.
Better than Tim Hortons. McDonald's.
Steve, I would have pegged you for a Tim Hortons guy. I wouldn't have thought you were a Starbucks guy.
On cost, right? Yeah. Except I stopped wanting to drink pond water, so I went to Starbucks. It's actually like the crack, right? You go to it and it's like crack. You just, once Starbucks starts, you don't really like it the first time, but anyway, so we went and we had a coffee, and he's like, I'd like more of your business, blah, blah, blah. And I just basically, I broke it down. I said, hey, we're demanding, Chris does a lot of business. I don't know what the fuck I'm doing yet, but we're demanding. And, if you want, we'll give you a shot and whatever. So we kind of didn't, with any new business relationship in real estate, you don't just fire out all your business to the one person right away. But then something strange happened. Then I think it was a relative of Chris, if I remember correctly, got into a deal, and that person was like, no, I'm using my own bank. And so we had 12-day conditions. Their bank couldn't get it done. Then we got a 2-day extension. At the end of those 2 days, the bank phoned us and said, we can't get it done. It's now 3:30 on a Friday. And Chris turns to me and goes, remember that Rowan guy? Let's try him out.
See if
so we sent the deal to Rowan at 3:30 on a Friday afternoon. He had the deal fully approved and underwritten by 5 p.m. that day, and the buyer got the house. And it happened to be a relative of Chris's at the time. So that day forward, Rowan Smith has been my personal mortgage broker and mortgage broker of choice. Because I know we got a lot of mortgage brokers on here. But Rowan, welcome to the show. It's been great working with you.
Longest intro Steve's ever given to anybody that's been on the show.
It's great. So, but I mean, you know how important it is to have a good broker. You know what the heck's going on out there.
The only time our team ever has hiccups in transactions is that when we don't have a relationship with the mortgage broker involved. Like if there's someone new that the client's like, I have to use this person, it's like, fine, that's all good. But when we're all connected from the beginning and they're pre-approved and good to go, we never have issues. So it's like so important to have someone like that in your business.
In that particular transaction too, the client was my aunt, and she was her situation was complex, to say the least. and emotional and all this type of stuff. And so what the part that Steve didn't see, I just try to insulate everybody from, which is kind of one of my roles.
It's actually important to say because there's so many times where shit almost hits the fan or is about to hit the fan in our businesses. And we kind of got to go get it figured out, find the solution. And then you kind of tell the client after the fact, like, hey, just want to let you know, this is taken care of now, but like, this is what happened. But if you had just gone to them and said like, oh my God, all this crap's going down, that's not a great way to run a business.
Well, I would say like in these transactions as a broker that's handling the financing, I always feel like I'm kind of the airline captain. And, the airline planes I've been on, I'm sure have had problems and I've never known about them. Right. They just handle their business. And there's times when something's going horribly awry on my side of the thing, and it's some little minutia point, right? But I don't want to drag the client into it or call up Steve and be like, oh man, this guy's pay stubs don't line up properly. His year to date's not true. Nobody cares. Okay. So it's just a matter of trying to mitigate it, make the problem go away so that nobody knows there was ever a problem.
Okay, now which bank is the easiest to deal with and which is the most difficult to deal with? You don't have to answer that if you don't want.
I'm happy to help those guys. Or some of them need correction, but are generally like most brokers have like a top 5 that we use, and it's partly a relationship, and it's usually one thing for different things. Like you'll have one lender that's super fast. You have one lender that's more flexible on income or more flexible on they don't require as much down payment history. And each one of those little things, you kind of have one chambered. So whenever I get a client, it's like, we know right where it's going, just based on the fact pattern and based on what they're doing.
And have you always been in the broker channel? Did you ever have a career at the bank beforehand that then led you here?
Yeah, I kind of actually got to start. It was in automotive racing and then automotive parts sales when I was way back. And then I went into banking. It was supposed to be a summer job. I never intended to become a broker. That wasn't on the horizon. But I was watching guys that were brokers at the time coming in and cashing checks that were bigger than my annual salary. And I was like, what is going on? I got to get out of this business. And so I was 7 years in the bank, and then now it's been 18 years brokering. So I guess 25 years in business. But
at the bank, were you in the same thing? It was like a mobile mortgage specialist type of role or doing something else at the bank?
Yeah, no, I did not do mortgages at the bank.
Oh,
I did. I was on the kind of the investment side, so I did a lot more like RSPs, RESPs, corporate account openings, merchant account sales, and stuff like that. And I had gone through the training, and I used to work at Coast Capital Savings, and they had this lender certification program I'd gone through, and the move was to move me into that direction. Mm-hmm. But I was just shadowing lenders. I wasn't actually doing mortgages. And so when I left, it's not like I had a book of mortgages or a book of clients I could call. Like I had zero. It was just out there networking events and pounding the pavement.
What did you do as this is just generally, I'm curious about this. Just anyone that starts a business, me and Steve are obviously in real estate, you're in the mortgage side of things, but we all started from basically zero and got our ass kicked for a little while and then kind of found our groove and that kept going. When you started your business, what did you do to find opportunity?
At the time, so I moved downtown about 6 months before I became a broker. It was by design because, mortgage brokers are paid based on the size of a mortgage. We get paid the same job at $250,000 mortgage versus $1 million. It's exactly the same task. You just get paid 4 times as much. And so I wanted to go where the land of big mortgages were, and I went to Vancouver. Houses at the time in Surrey, my friend bought one for $375. And flipped it for $425, and that was an unholy sum of money to me. And so I was like, "You made $50,000 in 3 months? Like this? How can that possibly be the thing?" So I moved to Vancouver to get into it, and I did probably 3 to 5 days a week of networking events. There used to be this group called Small Office, Home Office, and BNI networking events, and Vancouver Board of Trade breakfast roundtables. And I was hitting the networking circuit, and the key always was the follow up. Right? It was if I met someone that was interesting. And what they did was interesting, whether I was going to use their services personally or refer it out to friends or whatever, I would go and have another coffee with them and follow up and actually have an in-person meeting because like now everybody just sends out a text. They send out something digital, right? But I don't know. I still think the lizard part of our brain wants a human connection. That's why I don't think like AI is going to be as disruptive to our business, to my business specifically, as people think. It's going to affect it. Don't get me wrong. But, people want answers, and they usually want answers from somebody that at least presents as competent and has experience. Mm-hmm. And just typing it into a chat bot is not going to cut it for a lot of people.
I think we're all on the same page there. I will say one of the big things that Apple just did their developer event. I saw that. Lots of crazy AI stuff. The kids doing math these days can just write the formula on the iPad that gives them the answer. I don't know how the teachers are going to deal with this, but I was most impressed by something that Android users have had for, I think, 5 years, is the next update for Apple phones. You can schedule text messages. And there's so many times I'm up at 6 a.m. being like, oh my God, I forgot about the thing. I want to message that person. And you could always schedule emails, but there's something more personal about a text. Imagine as a business owner, I can go into all my clients' birth dates for next year, and I can schedule texts for 7 a.m. on the morning of their birthday. I know it's less like human, but I don't think it's going to tell them.
I'm going to schedule my personal touches in my business. What a guy.
Well, come on. Birthdays don't change.
As of last night, Steve, we have a client we're working on right now that's in the subject removal period, and he texted me at about 10 o'clock, and I got back to him at 11:30. I was like, oh, right. There's another point I need to make on this. And I'm like, I don't want to be that guy that sends out a creepoid text at 11:30 and then it wakes him up or something like that. So I was like, I'll wait. I
sent out a text this morning to a prospective client whose listing expired with another agent yesterday. I sent it at 6:15 this morning. Your property's been off the market for 6 hours. Let's go.
Did you really?
Yeah. You've been off you haven't had an opportunity to sell for the last 6 hours. Let's rock and roll.
I guess you got to be careful though, because if they re-signed an agreement in between that time that you didn't know about and you had a text scheduled.
No. Get out of here. Get out of here. So Rowan, update me on what's going on out there. So we have, I am most interested to know this right now. So when I'm dealing with you, if you've reached out to me, you likely get a list of mortgage brokers. Rowan is on that list. We'll get a couple other brokers from a few other banks. Say, hey, get your opinions from these folks because these are good folks. When we work with Rowan and they're pre-approved, they've gone through those steps. Those deals, I'm going to say 99%, if not higher of the time, get approved because Rowan knows what the heck he's doing. But we quarterback with if it's Rowan or if it's anybody else, we quarterback our deals through. And like, for instance, Rowan, the deal we're working on right now, like you get that contract from us, right? Like if Chanani on my team, I think is writing that deal right now, like as soon as he accepted offer, it's like sent to you, CC'd to the clients, like all the communication is all together. Is that your experience with everybody else in the industry, or are you like getting piecemeal contracts coming just from the client and you have no contact with the agent at all? How's that working?
Well, I'll give you the other side of the experience. So I have a client that reached out to me, and her and her sister and her mother are buying a property in Victoria, and they asked me for a referral for a realtor over there, and I don't actually have one that's in Victoria proper. Tony, you found somebody.
Yeah, we got a few for you if you need one.
Okay, I'll keep that in mind in the future. So that when they got the accepted offer, I get a call from the client, and she goes, "We got an accepted offer," and they were surprised. Like they accepted it, and we're moving forward. And I said, "Okay, I need a copy of the contract, the full realtor MLS listing. I don't want just a public facing one. I want the one with realtor comments, and the property disclosure statement." And I said, "That's all I need now already." I'm usually pretty diligent when I know a deal is going to go live and someone's going to be writing offers about having most of my income documents and stuff clear already. Otherwise, they shouldn't be shopping, in my opinion. And so I'll ask for those items. But the problem is I don't even know who their realtor is. So I have to ask the client. And how diligent is the client about checking their email? And then, sometimes the client will call it and then it goes back and forth. If it's a realtor I've worked with before, like, and one of the things, like working with Steve's team, they've done enough deals over the years, so many that they know where the minefields are. And like little things like, was it going to be a problem if they got their down payment and it came from Uzbekistan last month? And it's like, yes, we got to talk about that. We got to sort out this down payment thing. So, but other realtors don't. And they use the 3 words I always hate. Can you get it done? Right? Which is not like, is it the best situation for the client? And no, that never comes up. It's just, can you get it done? Can I slam a commission check? And that's Pareto's law in full effect, right? It's 80-20. 20% of realtors are really good to deal with. And sometimes I just get a full document set from a realtor I've never had a conversation with. Just boom, I get everything, strata docs, the whole nines. And that's not the usual experience. And then other times it's piecemeal. It's usually me going, oh, and I need this. And I hate being that guy. I hate being the guy that says, here's 5 things I need. And then you give them to me. And then I've got to go, oh, and one more. Oh, and one more. Like, that shouldn't really happen, except that people don't always know what's on their documents. Like they go, oh, I make 60,000 a year, and they show me a T4, and I go, that's great. And then I look at their job letter, and it's like they're not guaranteed hours, and they're on a temporary basis, and it's a 1-year contract, and I'm like, oh my god. So
you had said something about the MLS getting the one with the broker remarks. Mm-hmm. How do you feel when someone buys a house and you get one with the broker remarks, and the first thing it says in the broker remarks is handyman special? Easily this is gonna blow up.
Lot value only, sold as is, where is.
That's the one. As is, where is.
That's a scary one to see for a lender, I'm guessing.
It's not great. I mean, it all depends on the photographs. Like I've seen some wild photographs when I look and I'm like, these are the photographs that an agent chose to put on their listing. Like, which ones didn't make the cut? You know what I mean? So that's usually pretty comical.
I was looking at a comparable the other day for a client of mine. A house down the street sold, and it was like, going through the photos, and all the photos are fine. And I get to the basement photos, and it's like a nicely staged property. And in one corner, there's just a little Chucky doll in a little, like, I'm like, nope, I'm not going in that basement ever. I don't.
The ones that always blow me away are, this guy had his cabinetry. All the doors were off the cabinetry, but they were just on the ground in front of it, like propped up in front of it. And the appraisal photograph took this, and this said this was one of these handyman specials. And in the grand scheme of things, putting front cabinet fronts on, it's not that big of a deal, but it just speaks to this overarching lack of maintenance or craziness or what's going on. So
I actually think if you're looking to get a quote unquote deal on a house, you buy a house where all the photos of the bathroom have the toilet seat up. I can't tell you why, but that house will sell for less. And if you can see a reflection of the photographer in any of the photos, probably you'll get the house at a lower price than it should have sold for, because it's not being marketed correctly.
I feel like I've got my house at a deal because the agent was a friend and they were giving them a deal. So they took iPhone photos, and this was I bought my place 20.
Oh, this was your house.
My house, 2013.
Okay.
And like all the pictures, I don't know what iPhone you had, how many megapixels you had in 2013, but they were horrible pictures. And the house is beautiful, but because they cut, I guess, their commission, the person's like, I'm not hiring a photographer for this. I think I got a deal.
Hey, real estate agents, I'm going to ask you a very simple question. Are you proud of your current website? If there's any hesitation in your answer, what I want you to do is go to realtyninja.com/Tom. They provide amazing websites for the real estate industry at an affordable cost. Steve has been using them for over a decade. realtyninja.com/Tom.
If you are a real estate agent in Ontario, you know that it's your obligation to explain RECO's information guide to your clients. And now TRESAvideo.ca can help make that explanation easier and increase your trust and transparency all at the same time. Tom's team has been using the video that they got from TRESAvideo.ca for a few months now, and both his agents and clients love it. And now exclusively for the month of June, you can use code JUNE50 for $50 off your purchase. So go to TRESAvideo.ca and enter code JUNE50 for a limited time.
Yeah, so there you go. So right now, you've been doing mortgages for a long time. It's not easy to get a mortgage. I think we talk about this a lot, where like I just went through sending all my stuff in to move a mortgage over, and I've already been made fun of in the comments about the penalty I paid to make it happen, but I'm happy with my decision. For the average person right now that's reaching out to you, like how many people that are reaching out are just, it's good to go, you're totally good, versus like you're having conversations with people that are like, hey, you're approved for this, but you can't buy anything. Has that changed? Yeah. Has that shifted?
Well, the interesting thing, and that people, they look at these rates and they go, oh my goodness, these rates are high, right? These rates are not high. When I got into the business, I was selling 5.89. That was my first mortgage I ever did, was a 5.89 mortgage. They went up to 6.29 at the time. Yep. And when I was in banking, that's the range they were at. It wasn't until the financial crisis that we saw rates plummet, right? And now we put the stress test in, and the stress test was testing what rate people can afford, 2% higher than their contract rate, or this baseline of 5.25. So when rates were like 1.89, right, we were testing at 5.25, 2.89, 5.25. It wasn't until they crested 3.25 that suddenly there was an impact being felt. And when that happened, I noticed it. There was an obvious dip and slowdown in activity. But then we're sitting here now, and everyone's going, "Oh, these rates are high. These rates are high." they're at 5.25 roughly. Like that's a decent rate right now on like say a 3-year term. It's not the best, but it's right in the middle there. And if you're getting 5.25, we stress tested you before. Like, are you having problems with the payments? You shouldn't be, because we've already kind of run the math. But now we're stress tested at 7.25, and now that starts to look like the stress test should have had some dynamicism built into it, where it was plus 2% when we were sub 3. It was plus 1 when we were sub 4. You know what I mean?
Right.
But in hindsight, of course, there's talk about them adjusting it, but it's not on the horizon. We weathered the storm, so to speak. So they're happy they put it in.
There's so much talk about the stress test. Like from what you just explained, I would look at that and go like, it did its job. Like, thank God they put in that stress. Could you imagine what could have happened in the market when things were going crazy if there was no stress test? It would have gotten it got nuts, but it could have gotten way worse. But it's a good point. It's like they put that in because they maybe didn't think rates were going to do what they did. But now that we know, you're like, what's the chances that rates get to 7.5%?
Yeah, I think it's pretty low. I was checking the bond yields this morning, and like they're down again. And there's data that keeps coming out that like I've been screaming they should have lowered them. If they were going to lower them and they were concerned about inflation, they should have done it a while ago. But then on the flip side of things, I think they had to wash out some of this inflation through keeping the rates high. And I mean, I argue they should have kept them longer even than now. But
you didn't think they should have done that first cut?
Not yet. Not just yet. There's a little bit more data I'd like to see come out. Like, for example, inflation is a rate of increase, not a price level, right? So the thing that I always say is the rates really went up in 2022, 2023, and they peaked in like August and September of 2023.
Yep.
I was selling mortgages at 6.39, 6.59 at some of the credit unions. Since then, it's been down. So now when you're looking at the inflation numbers, when you're looking at from today's date, 1 year back, there's a precipitous decrease that's happened. And it's not being reflected in the stats yet because we're still looking at June and July from last year. So as we get further along here, suddenly that component of the consumer price index, which is 25% has been mortgage payments, it's gonna stop being an element. And I think we're gonna suddenly see those inflation numbers go doink and drop down. And people are gonna go, oh my goodness, there's actually recessionary effects going on here right now. I mean, I do a lot of construction financing. I build stuff myself. We were paying at one point like $120 for a single sheet of plywood, good one side, 5/8 plywood. It's down at like $40 now. Certain things, 2x4s were up at $20 in some cases, depending on your market. They're back down to $10. Like, things have come off, but where I don't see it coming off is like the grocery store stuff is still just bananas here. Yeah. I don't understand how that works.
Really, a cucumber is the same price as an avocado. News to me. With the construction materials, though, so you said they've come down from the peak, but
certain things.
But where are they versus 2018 or 2019? Like, did they come down to where they were pre-pandemic?
No.
They're still higher than that.
They're still higher. There's always going to be some inflationary component, right? I mean, they're targeting 2% and inflation, so we're always going to see it higher, and that'd be an extra 8% increase in the last 4 years. It's probably more than that. Like, I do still think it's higher, but certain things are weird too, like plastic piping for doing the water in a house, like PECs and stuff like that. Stuff hasn't even moved. It's still expensive. I don't know if it's because it has to be produced overseas and then shipped here, and then the shipping costs are the shipping costs. They haven't fallen at all. So I'm not sure. But yeah, it's noticeable. We see the prices on that stuff come down, which means the end product's cheaper to build, right?
But your inflation numbers could change quickly, as you said, because you're going to have deflation in mortgage payments, technically, likely. And you're also going to, like, for instance, our gas went from $2.23 a liter or something a few weeks ago now to like $1.78. I don't know what it's doing in the rest of Canada, but like that's a big deflationary number as well if that were to keep up. So you could actually come into a deflation situation really quickly. What I'm trying to figure out is, why is deflation bad again?
Yeah, I've never understood this either. I've had people try to explain it to me like, well, the monetary system has to keep increasing in size and all this. I'm like, why? Why can't we just have a period of stability, like where things aren't going?
get more for my money for a little bit. Why can't I go on a vacation and have things be cheaper?
I remember when Canadian dollar actually was at par, like back in like 2008 or 9, like during the financial crisis. And I had bought some tools and equipment, and I was like a big welder and stuff like that. And I remember at the time, I was like, wow, the price is relatively cheap because it was actually made in the USA, which you wouldn't associate with cheaper. That same welder, the same version of welder I was looking at the other day is like $6,500 versus $2,200 I paid at the time. So you factor in what percentage increase is that, and it's the labor component. It's always the labor component is still brutal.
I'll tell you, the only thing that hasn't seen inflation in the last 10 years, this is a very personal experience for me, is rent-a-goalies playing hockey when you need a goalie. It's been $50 for 10 years, cash. $50, it's never changed. I would, if the goalie should get a union together and increase their prices.
Is that how much you made last night, Tom?
No, I didn't play last night. I'm not a goalie anymore. I play player, but sometimes it means to rent a goalie. It's been $50 forever.
I got a question here. I got a question here. Specific. So you said like 5.25-ish right now is okay. Rate Hub is telling me 4.64. Why are you ripping me off, Rowan?
I'm going to get, that's a CMHC insured rate. I was quoting kind of a conventional rate. And that's the thing about my market, Vancouver, our market, is it's mostly conventional business. And people don't understand, like, they go, well, wait a second. So if I put 5% down, I can get 4.64. Yes, you can. All right. If you put, now that lender is a small credit union. It's regional. They don't lend everywhere in the province. They certainly don't lend. Like, I'm licensed in Alberta as well, and I can't do that deal there. Mm-hmm. But some of our credit unions in BC right now they're just really aggressive. But people don't realize that when you put 5% down, that bank has CMHC insurance. They have a guarantee they're not going to lose any money, and so their source of the cost of funds for them to fund that loan is lower. When you put 20% down, you think, oh, I put this big lump of money down. If you bought a $1.3 million place, you're putting $260,000 down. You think, like, why is the guy why am I paying 5.25 when this guy's paying 4.74? And the reason is that bank has that insurance in there. The maximum risk loan a bank can take is 20% down. That's the biggest loan they can do without CMHC insurance. So what we have, there's a tiered system where when you have 20% down, it's one rate. It's 30% down, 35. We can get better rates depending on the purchase price of the property and a whole bunch of other factors. But the more you put down, you can get better rates because that risk element disappears. So
one thing could you explain this? So I obviously know the answer to this, but I'm going to ask you this because I realize there's going to be somebody watching this video that's never gotten a mortgage before. And I feel like us having these conversations, because we do it all day, we kind of just like say, oh, conventional loan, CMHC mortgage. Some people, that was just gibberish. And I know most of our audience is a bit more advanced here, but just for a first-time home buyer, like why is less money down better rate? Right. And what does that mean for conventional versus insured? Like, I know the answer, but could you break it down as a mortgage broker? Like, there's someone this will be helpful to.
So conventional lending is when you're not having CMHC involved in the process. Okay, CMHC is the mortgage, the default insurance that you buy so that the bank has the pleasure of having a guarantee that they'll never lose money. So it gets added to the loan and paid out over the life of owning the property. Conventional loan with 20% down or more, or anything that's not insurable. So to be insurable, a loan has to be a property has to be worth less than $1 million. The amortization can't exceed 25 years. It has to be a purchase, not a refinance. And it can't be a rental. Right. So in those circumstances, that becomes what a conventional deal is, right? And the way that it's foolish the way that the rates are lower when you get the CMHC insurance, but it's just because they've got the guarantee. Right. So someone who's putting the 20% down doesn't have to pay a whole bunch of CMHC insurance premiums. So they save a bunch of money there. But then they pay a slightly higher rate, which is bananas to me. It didn't used to be that way.
Do you know, like, we're seeing all these headlines now with delinquencies are getting worse. The total sum is over $1 billion in Canada. Do we know? So some mortgages are insured, some are not. I don't actually know how it's split throughout the country. Like, do you know those numbers? And then if we look at the people maybe right now not being able to make their payments, are they the insured mortgages or do you know the answer to any of this?
I don't know the answer. I don't know the actual numbers. I wouldn't be able to cite them. I could get them for you fairly fast, but sure. But the thing is, the delinquencies, there's a little bit of obfuscation of these numbers. They're like, it's gone up 200%. But it went from like 0.2 to 0.6 or something. You know what I mean? Like it's a very, very small number. Do I have borrowers that are in some financial trouble? Absolutely. I take a call every couple of days with someone who's like, oh my goodness, like I'm up for renewal. My payment's going from 1,700 to 3,200, right? Like big increases. We're not 1,700 to 1,900 is weatherable, but you start doubling people's payments and stuff like that. So I've seen some of this, but I'm not seeing people that are in financial distress. I'm seeing their lifestyle compression. That's more of what I'm watching. I'm seeing less of their Instagram posts of them in Mexico and more of them, whining about mortgage rates. And I get it because like everybody's myopic and they look at the last like 2 years of their life, and to them, that's all they focus on. And so they think COVID rates are normal, and especially younger people coming into the market for the first time during that period of time had the impression that like, oh, this is what the cost of home ownership is, and it is not, right? It is higher. I mean, I think of the maintenance I have to do on my house, the amount of stuff my Home Depot account, like I hit status as a contractor for goodness sakes, and all I do is stuff around my own home.
When rates were going up in 2022, there was a period of time that because of the stress test, you almost had to take, you didn't have to, I should rephrase this. You didn't have to take the variable rate, but it was so much lower that it's like, it's worth the risk. We found out the risk was didn't pay off, right? But at the time, just think back, we didn't think they were going to go up this fast, right? Now, on the flip side of things, okay, the variable rate is still very much higher than the fixed rate right now. Like what's a variable, 6.5? Is that where it's at now?
Yeah, that's about it.
And fixed is 5 and a bit or high 4s depending on insured, uninsured. Now that we believe rates are not going to continue to go up, and even since Bank of Canada made their announcement, I know the fixed rate actually did tick up a bit because of the bond yield and things like that. But on the perhaps way down or slow progression down in rates, is everyone now just saying like, well, just give me the 3-year fixed? It's the obvious answer. But do you think people risking the variable right now, maybe in the next year and a half, it won't make sense, but after that, they're going to actually start looking smart, like the opposite of what happened on the way up?
Maybe. I would say doubtful though. Okay. And the reason I say that is if you're at 6.5 versus 5.25, that's a 1.25 spread. How far down does that variable have to go to break even? Well, to break even is obvious. The answer is a 1.25, but to break even over the life of a 3-year term and to save money, I would argue it's got to go down a 1.25 by at least the halfway mark, and then another 1.25 by the end. So that's 2.5 points coming down to save a bunch of money. Is that going to happen? I would say that is unlikely without another black swan style event or a massive recessionary data coming out, that kind of thing. I'd say it's unlikely. So I put the money where my mouth is. I took a 3-year on something that renewed July of last year. People will often say, like, can we get the 1 year? Can we get a 2 year? And it's like 1 year is like 7.3, 2 years 6.4 ish kind of thing. So again, you're going to take that big hit, or you can get the guaranteed savings right now. And so I like the idea of right now.
Did shorter mortgages previously, like I wasn't following, I've always just been the sales side. I don't really get involved in the mortgage side. I let the mortgage brokers deal with my clients. Shorter mortgages used to be lower in the past, but now it's inverted and they're higher.
That's right. There's something that people that follow this will know about, they call the yield curve, right? Mm-hmm. The yield curve it should start down at 1 year here, 2 year here, 3 year here. It should go up in not only linear progression, but there's a curve that should show that you get rewarded as an investor, which the bank this is their loan as their investment, for taking a longer term. And it's inverted right now where short term is more expensive. Most economists will tell you that almost 100% of the time that happens, a recession follows. Right. And so I'm not going to be the one that says, but this time is different. I do think that there's some trouble ahead for like the greater economy, never mind the isolated real estate markets. But it didn't used to be this way. To your earlier point about people taking a variable when the rates were lower, it was there was a glitch in the way that the stress test was made, where when variable was like 1.8%,
right,
we would test at 5.25%. Right. And when fixed rates were going up and up and up, when fixed rates got to 4%, we're testing at 6%. But if you take a variable, 5.25%. Right. So it was a way of gaming the system. And people would then take a variable to qualify for more and then walk in the branch on day one and they'd switch back to a fixed rate.
Oh, they would. Right? Okay. Well, the smart ones would, because lots of people didn't.
Would have been the smart thing to do, but a lot of people did not do that.
Well, there's that psychology thing, and I always call it the creep, which is rates are at 1.89 and fixed is at 3.25, let's say. And then this is what was happening in early 2022. And then people go, okay, well, I don't want to lock in at 3.25, so I'm going to stay in my variable. And then the variable kind of goes up to 3%. And they go, oh, what's a fixed rate right now? And I go 4.5. And they go, oh, right. And then they never make the jump. And I had friends asking me, when a couple of my friends are like, should I jump over now? And I was like, this is in June 2022. And I was like, jump over, get into fixed. Look at the rest of the world historically, they're pointing to me and going, well, Rowan, there's negative interest rates in Amsterdam. And I was like, stop it. Take the win here, right? Run out the clock. And some of them did, many didn't.
It was July 13th, my birthday, 2022, that they did that 1 full point increase. And that was people didn't realize how big of a deal that was to go up a full percentage point in one announcement. People don't realize how crazy that was. Tom, you alluded to this, something I clipped and I wanted to talk about. It's going to make a great title for this video. A shocking number, in quotes, total mortgage balances in severe delinquency exceeds $1 billion for the first time, apparently in Ontario. So this isn't national. This is just Ontario. You mentioned that. So this is the one thing us realtors and mortgage brokers and everybody like to say, well, these defaults are still lower than pre-pandemic levels. Well, this is the first article that came out where we've exceeded the pre-pandemic level. Just barely. So it says 0.14%. So still a really small number in Q1 were in default of this year, when it was 0.09 in Q1 of 2020. So we are now just above mortgage delinquencies. This has nothing to do with foreclosures. This is not there yet. These are people that have missed payments. So the missed payments are increasing, but it's still a fraction of a percentage. So I think these news articles, they're scheduled to come out every single year, when the bank puts aside their reserve for delinquencies, and they always have to increase it, as obviously they would, because properties are more expensive and mortgages are getting bigger, as you would expect with inflation. These shock pieces come out and they're just prepare for the end. And then when you look at that number, you're like, wow, $1 billion seems like a lot of money. And then it's 0.14% of total mortgages are in arrears. So to me, I don't know. It's craziness. What do you think, Rowan?
I agree. I think it's alarmist. It's clickbaity. When the media does it at large, I see those kind of articles all the time, and it bristles me because I'm like, don't scare people unnecessarily. Expectations drive or sentiment drives everything, and people don't realize the scale of things either. This is always an interesting number. So back in the 2008 financial crisis, when all these banks were being bailed out, and the government stepped in, and the bailout package was passed in the U.S. at $700 billion, and they drew down $450 billion of it or something like that. And for scale, we've grown so big, the debt bubble, since that period of time, that when Silicon Valley Bank had problems and went down last year sometime, and there was that whole issue with the run on Silicon Valley Bank, they alone were bigger than the entire U.S. financial crisis.
For tenant, landlord, or homeowner insurance policies, go to squareone.ca/the Tom Storey Show. Use the link in the description. Save $20 when you start your free quote right now.
The money that was at jeopardy at that point was larger than the $400 million, and it was one bank, right? So you think of how big this has gotten, and to hear $1 billion in arrears, and you think, well, how big is $1 billion in terms of the debt in Canada? It's it's not very big at all. It's probably 0.14% of.
Should that actually be more concerning though? That $1 billion's not even a drop in the bucket anymore.
That's a different discussion for sure. That's where's our system going?
Right.
These numbers are crazy.
I don't know. It's we're always going to see articles like that, and that will probably be, Steve, the title of this video, I'm sure.
I'm sure it will be. We need clicks.
Okay. I want to ask some specific mortgage questions about people that are thinking about they're refining right now, they're getting into the market. if you are this person that's really trying to time things out, which we've learned is impossible.
Asking for a friend. Tom's asking for a friend.
I'm not actually asking for me here. I saw this somewhere else and I wanted to ask you. Can you take a mortgage that's like a 3-year fixed and half the mortgage is on the fixed side and then the other half the mortgage is on variable? Can you do that,
Yep.
that style of mortgages? Is anybody doing that just to kind of risk both sides? Steve is?
Steve notwithstanding. Yeah, not many people. Usually when they are, it's because they've got a line of credit component and a fixed component. But like we used to see, who was the advertisement? Scotia used to have it. It was like they have the husband-wife, fixed, variable, fixed, variable, arguing over dinner, right? And it was like, well, now you can take half. So not all lenders allow this. Usually it's only the big banks and the credit unions. It's not a lot of the broker channel kind of discount lenders, but they'll allow you to set up multiple tiers. So you could have it 1/3 fixed 3-year, 1/3 fixed 5-year, 1/3 variable if you were so inclined. And you could break it all up. Some lenders have a max of 5 tiers and all this kind of thing.
You do 5 tiers.
There's some that are even higher. You can do I think manually for this huge number. It's 10 or something craziness like that. I can't remember the X number. We know one uses them. I don't know anybody that uses this many tiers, but I believe I know that you can have multiple. And the advantage / disadvantage of taking like different 3-year and then a variable is typically 5 years. When you've got those two things and you now have two competing maturity dates, which means that at any point in time, you're going to have a penalty if you decide to pay that out. You can't wait to the end of the term and then make a decision. So I see a lot of people they'll port the mortgage and they'll be with I'll throw Royal Bank under the bus because I see them the most commonly with this particular structure. They have their home home line, I believe it's called. And so someone's got a 5-year fix and they're 2 years into it. And it's like, let's say it was back at one of the good rates before, they had a 2.5%. So they port that mortgage over. Now, when they do that and they get new 5-year money, the bank doesn't always have that discussion with them saying, we should align your renewal date of your first tier with your second tier. I always point it out and say, whoa, you're 2 years into a 5-year, you should get a 3-year, just as an example, so that you line those maturity dates up, because otherwise they've got you over a barrel. And I've had a client who's been wanting to come over to me and I have better rates every time, except that when we factor the penalty in, I'm offside again, right? And so even if I'm giving him cash back and all this other stuff, it never breaks even. And he's always stuck at RBC now and their rates are giving him are good, but they're not great, right? And so that's one of the things I just encourage people to watch out for is the multi-tiered mortgages. Make sure the maturity's low enough.
Of all the big bad banks, is there one that you prefer the most of the big guys?
Well, there's rate considerations, there's service considerations. Not all of the big banks are in the broker channel. CIBC left the broker channel some years ago. There's always talk of them coming back. Bank of Montreal's just put their toe back in. TD and Scotia are the two big ones in the broker world. And they have very different reasons that we use them. The service that we get at Scotiabank is like top shelf. It is crazy. I'll submit a file and I'll get like a notice that my underwriter has picked it up in like 5 minutes. And sometimes they'll kick it back to me and go, thank you for the deal, an hour later. And other lenders, some of the credit unions are smaller. They got small underwriting centers. And so when they offer a rate promo, they might go to 2 to 3 weeks to get a hello. We had one credit union, I don't want to out them because they've improved dramatically, but we had one credit union last year that used to send out an update in the number of weeks to get a file. It wasn't like the number of days. It was like, we're at 4 to 5 weeks to pick it up. And so I can't use that for a purchase. It's just not
for a purchase, but for a restructure or a remortgage or something, you can. Okay, so let's run this experiment. So I just had Rate Hub 464. They want to try and get your business somehow. They phone Rowan. Rowan's offside, as you put it, with your rates because Scotia on the same bank says a 3 years 519 or something like that. So maybe let's do this. Let's say if we have that low discount that's being advertised and they don't even put the name of the institution advertising it. And then you have, say, a Scotia or a TD who are going to probably be a couple of your more go-tos or for different things. Why would you use Scotia versus TD? And then what would it take to actually get that 464 rate or whatever that super low discounted rate is? Give me those maybe 3 scenarios.
So, so scenario, if I was going to use TD or Scotia, Scotia would be my go-to for if I need a quick turnaround. There's only a couple days left on a subject removal or just they've got a tight window. But TD's very good too. Like they're not, they're well run. They used to have a different system where they were all adjudicated out of this central center, and they still are, but now it's be local, and they're very good. But TD has just very different policies in terms of income. If I have somebody that's got 2 different part-time jobs and they do Uber Eats on the side, I have a way to structure that with TD that they accept the multiple sources of income, versus Scotia can be a little tighter on that. Depending on what product somebody wants, you can't fit more than 2 borrowers on some of Scotia's products. So even when it comes to their step and their line of credits and stuff like that, so there's limitations, and it's all little tiny nuts and bolts stuff like that. If it was someone wanting the ultra low rate, those rates typically come out from what we call mono lines. That's the word we use. They only sell one thing, mortgages, and they're not after your banking. They don't even offer it. Okay, right? It's just they just do mortgages, and they will often. There's one particular company out there right now who's down at that 4.64 rate. They're very small. You got to watch out for some of the fine print on mortgages. Like, is there a reinvestment fee if you break the term? That's something that crept into the language the last little while. If you break the mortgage, there's a penalty, and then they have to reinvest those dollars, so they charge a reinvestment fee. And it's like, what's the point of the penalty if that's the case? But there's always these little things to look at.
Okay, so the rate cut happened, and based on the conversation we've been having so far, is you look at it like, okay, we think more could potentially come, and you actually think the numbers could start looking not great at all. Like they can continue go down here. So, like, is there a possibility we got this totally wrong and they could increase rates again from the Bank of Canada? I guess everything's a possibility, but if we think the data is going to keep getting worse month over month, they could. Like, what do you think now? From now till the end of the year, could we get to 4% overnight rate if the numbers keep looking not great? Because all this bad news, unemployment went up again here in Ontario. I think almost 7%. It's not great. Like, I was seeing people posting like there's more unemployed people in Toronto than there is in all of Quebec, like all people in Quebec or something like that. So, like, you know, those are great headlines and things like that. And delinquency rate for mortgages and all of this, you know, now moving forward as someone that tracks things and has conversations with clients, like, you know, is Bank of Canada, you think they're going to be aggressive now, or it's going to be a soft kind of 25 point here and 25 point here?
We're the first of the G8 to move. We blinked first. So we also had the lowest inflation relative to all the other countries, though. Like, we actually, you could argue that Bank of Canada did what they were supposed to do, right? And that the rate increases had the desired effect. You know, I don't think we're going to see 4% kind of overnight rate by the end of the year. I wouldn't be surprised to see 1 to 2 more quarter point drops. That wouldn't shock me, just based on the trajectory of the data. I'm not sure the next one's going to be in July, like people are hoping, but I wouldn't be surprised. And also, there's a couple things that are playing into this. There used to be a product that CIBC offered through one of their ancillary companies called the Presidential, and it lined up the maturity date to be about 4 months before or right before the presidential election, because historically rates would go down as the Federal Reserve tries to juice the incumbent party to make the market and everything look rosy. And so there's been a lot of talk that we're going to see a rate cut in the U.S. 2 months ago, there was no way. They were saying like they were very, very tight on it. And all of a sudden this month there was a bunch of commentary like, well, you know, Canada's dropped their rates and, you know, we may follow suit. And it was like, okay, so magically it's right before the election. So that there's that historical piece that we see those rate reductions, coupled with the decline in the inflation coming down. I really think that when the September numbers come out, that's where we're going to see the big dump on the CPI from us, the consumer price index, just because of the mortgage increases will be out of the math. So, but rent is wild too, right?
Well, that's like, what's the alternative now? So these people that have their mortgages coming up, and you know the payment goes from $1,700 to $3,200, and yes, they were stressed, but you know the grocery store is costing them double the amount than it used to, and all these other things in their life. Is it like, find a way to weather this storm because eventually it's going to be sunny outside again, and you didn't sell your property and then go rent a place that's, you know, way more expensive than it was 5 years ago? Like, what are these conversations with people that are like, what do I do? Like, my payment's about to be double. What's next?
Yeah, I don't know an easy answer to it. People are just, weathering the storm is really the only way. I mean, you have to up your game and increase your income. That's you know, wage growth is also, we've seen that. Like, I've never seen the job letters I'm getting and the T4s I'm seeing right now. People are making some good money out there. I'm not saying everybody, but like I'm seeing, especially in the tech space. My goodness, I've got many applicants that are making $300,000, $400,000, $500,000 when you factor in stock options and stuff. And like, I was not seeing that before. So that's a new thing.
That's interesting. Steve, what do you think?
I don't know.
Should people sell their place and go rent? I know you always have opinions on this.
I didn't see that rate cut coming. Now everybody seems to be pricing in another one already for July. Like, it's going to happen quick. Like, we're going to get the 3 cuts now. I really don't know what the heck. I don't know. It's tough. I think the idea of guessing is kind of silly right now, because just as if we didn't expect it to go up so fast, I can see a situation where we're at 4.5 by the end of the year. I could also now see a situation where, like, if what Rowan's saying, what if our inflation or deflation rate comes in at -4 by October, because all that shelter inflation has actually gone the other way and gasoline's gone the other way. Then are we going to see just a smash down of rates again to try and get us back to that neutral rate? Like, maybe labor's still going crazy and housing starts going up again. And like, I don't know. I don't understand how it's all going to come together. I feel less certain now than I think I have at any other point. And I feel pretty uncertain most of the time. I feel like I can predict 3 months from now in the market pretty good. And right now I'm like, the market, the listings are starting to tick up again. The sales are starting to go down again, but product is moving. And stuff that's priced well is moving. So it just feels like a vortex of like, what the F is going on? I really feel like it's really tough to put a thumb on it. And you cannot bet on rates being down a 1/4 point in 6 months. And you cannot bet on them being only down a 1/4 point in 6 months.
I agree with you. The uncertainty, like, I've never had it where I feel this unclear about the future. Like, I really haven't. And so many other things, ranging from like American election to what will eventually be coming up to our upcoming election, and to all these types of things factor into it. One thing I do worry about is we reduce the rates too quickly, which is what they did the last big tightening in the circle in the 80s. You reduce them too fast and prices take off again. We have been bringing in a ton of people into this country, and they are skilled. Like, they're coming in under the provincial nominee program, where they're, tech coders coming in and full stack developers and stuff like that are getting really good jobs. And then we're going to want to buy a home, right? They're going to want to set up a family and buy a home. And you figure the number of people that are coming into the country is about 5 times the number of houses that we're building per year in terms of housing starts and building permits. So there's a ton of latent demand of people. I saw this poll talking about latent demand, and it was on some other real estate channel, and it was like, what are your plans for the next 2 years? And it was kind of like, hold tight, upgrade, downgrade, this type of thing. And it was like 80% was hold tight. And in the comment section, it was all people saying like, I don't want to lose my interest rate, so I'm going to stay out, hold this term. And 50% of all mortgages come due between now and March of 2026. So you figure there's a lot of people that are sitting there going, please get a little bit lower before we renew, right? Like, it's a very big sentiment.
I want to correct one thing you said. There is no other real estate channel. It is just this one. This is the only one.
It might have been yours, to be honest with you. Do you ever post polls?
Yeah, we do all the time.
Oh, we do.
Yeah.
But I just want to make it clear, like, we're the only one, and particularly on Sundays, we're for sure the only one.
Definitely the only one.
Just so everybody understands that.
I got a question on the construction financing side of things. So you were saying you're doing that is that just you personally, or you're lending money on other buildings as well?
Oh, I do a lot of. I finance other people's construction projects plus my own. But
what's going on there? Are people building things? Are we building the 4 billion houses we need, or is it that type of construction? What are you lending on? Is it purpose-built rentals? Is it sixplexes? What is it?
Better than that, can you share some of the stories about your development stuff that you've been? Because I mean,
my goodness.
Rowan used to have a little bit more hair than he did before he started his development.
Yeah, it's a red pill situation, blue pill situation. If I could take that blue pill and just go back to just being a broker and not trying to be a developer,
right?
My life would be so much more simple. But what I'm seeing people building is multifamily. Almost everything's going multifamily. I don't have any builders that I work with anymore building houses. Like, I don't have one. They've all gone into either purpose-built apartments, and on Vancouver Island, like there's been a lot of exodus of people leaving Vancouver and going to Vancouver Island because of the price point and whatnot. And labor is cheaper for construction and stuff over there. The land is way cheaper over there, so that's where all of my projects are on Vancouver Island. And when I'm arranging financing for our stuff, one is a 52-unit building that's got 18 townhouses and the balance are apartments above it. Some mixed-use stuff where it's commercial on the bottom and it's a purpose-built apartment building up top as well. That one's about 32 units. There's those style of things. That's what everybody's building, and that's where the money is being made. Is that as far as I can see in the development world, it's in the multifamily stuff. But you've got to keep your trades have to be on point. You've got to get locked in costs because just the kind of stuff that happens. Like we have this one project it's a recreational site, and we were running the power into it, and Hydro quoted us $26,000 to hook up the service, to install a pole, and to put a transformer there. A year and a half later, when we go to actually get the power put in, they go, not so fast. We're going to need 2 transformers. The pole has to be installed over here, and the cost for that's about $25,000 extra for the pole. And then to run this tech cable, which is direct burial cable up on the side, it's going to cost blah, blah, blah. It came to $80,000. So that was one line item in our development, went from $25,000 to $80,000. And we were like, no. I said, we're going to have to go get a new electrical engineer to draw out a different system, and then they agreed to it. They signed off on it, and we're kind of moving forward at somewhere in the middle, $45,000 or something. But that kind of thing, we've had all these things where we're applying for permits, and everyone thinks, construction and development is the way to go. It's the way to make money. You have to have a ton of cash to weather the permitting process. And when you added COVID to that, stuff that used to take 6 weeks has taken 18 months. And so we're getting hammered every month with payments because the lenders are getting paid, right? So it's I tell people, if you're going to go into a build, you want to have 35% of the land in cash and 35% of your cost in cash and a year's payments sitting there before you entertain that concept. So it's construction's way more cash heavy. I said none of my builders are building homes, but I have people that are building homes, individual private, they're self-builds. And they do things like they cheap out and they don't get home warranty. They, which here be, nationwide or not, I don't even know. But there's an exemption for an owner builder, but then it makes sale harder later on. And so, it's like spend the money. Don't be cheap on it. And they're going to need more than they think. That's always what I say. Anytime you're in construction, you need more cash than you expected.
I just think like that example specifically, and then you look at now, it keeps going up, the development fees to build anything. And like, how can a politician look Canadians in the face and say that they're serious? They're actually serious about providing housing that is affordable, or like it just, the numbers make it very clear they're not. Like it, no. I get the tax revenue, I get all that, but like it's at this pace, there's no issue that's going to be solved here.
No, it's a supply problem for forever. It's been this way as long as I've been in the business, and red tape just gets worse and worse every year. It doesn't get better. There was a talking point that I heard. I can't remember which politician said it, but they were saying we should look at some form of a system that incentivizes efficiency in the bureaucracy side of things. So, Mr. Town of Duncan and Chemainus over on Vancouver Island, if you want your federal transfer payments and federal money for these other programs, you have to hit certain timelines, and that they're actually accountable to those timelines. Because right now, like I call up a planner and I'm like, hey, we sent over the architectural drawings on this and you have to sign off on that. And they're like, yeah, it's on my desk. I'm going to have my team review it and the staff will circulate it for comments. And then I go, okay, well, that's fine. What's the timeline on that? 2 weeks. And so, 2 weeks the day I'm on the phone because it's never 2 weeks. I'm on the phone with him in 2 weeks going, hey, where's that sit right now? And I call the person up. They're on vacation for 2 weeks. The planner quit. It's been reassigned to a new person, and round and round we go in this vortex. If they would say, you're not going to be getting this federal money unless you can deliver. If you say 6 weeks, deliver in 6 weeks. Because what's really annoying about some of these permit applications, I've had these conversations with planners where I go, what are you actually doing? Like on my application, physically, how long does it take? But once I've got your eyes on it, like once I've got your focus, and they're like, a few hours, right? And I'm like, so if that's the case, why 6 weeks that turns into 18 months? Like, what is going on? And so, yeah, if there was a way to reward efficiency from the federal level, that would at least show me that they're trying to do something instead of these little, like, oh, you can take out more of your RSP. You take 60 grand out of your RSPs now. Do you know the number of first-time homebuyers that have 60 grand in? No, they've already gone and bought a house.
Yeah.
You know what I mean? So I don't know anybody that fits that mold.
I just think it's just not going to work like that either, though, because they're going to, okay, guess what? If you don't respond to your permit application in 6 weeks, the permit application's free, or you're not getting your money transfer or whatever, then you know what they're going to do? Their permit application will be answered in 6 weeks, but they're going to invent a pre-permit application because that way they're going to make sure that they can still stretch out that amount of time, right? Like it's going to be like, hey, have all these ducks in a row before you can even apply for your application. So I think it's actually going to do the reverse. I think it'll actually go even further in the other direction. I don't know what the answer is, but it just, there doesn't seem to be any solutions anywhere, and it just seems to take longer and longer and longer every time.
You know, I was likening it to the court system, which is people go like, hey, if I want to get in front of a judge and I've got a court case and suing somebody in contract law, it's going to be 12 months before I get in front of them. It's been 12 months for 40 years. You know what I mean? So we're not actually getting further behind. I always feel like, can't we just close the doors, turn off the lights, double down for 6 months? Let's get this backlog out of the way. You know, can we just do that? And the answer is always no.
Isn't there some new law in Canada within the last few years, like where if you aren't tried for your crime within a certain amount of years, you're just off because the court systems are too long? I believe that came in. There was like a situation where it was like, well, we couldn't see your trial in a certain amount of time, so you're free. Like, this is how crazy it is. It's just, I don't know.
Well, it's like debt. Like, people don't realize that if you don't take action on a debt that's gone bad within 2 years, it's expunged. It used to be 6 years, but it's been reduced to 2. So that it also includes mortgages. People will do mortgage lending, and then a family member will go into arrears, and they're not chasing them, and nothing really happens. You have to at least file something in those 2 years. Otherwise, that debt can be bounced. Like we have a guy that he owed somebody $75,000, and there was a bit of a mess on a sale of a transaction of a property. It was a construction deal. He was going to do some work. He didn't do it. Detail's not really that important, but 75 grand. Was 5 years ago. Well, the guy came up and started rattling sabers and threatening to slap liens on his property and all that. And the guy went to court and they threw it out and said, you haven't taken any action on this debt in too long of a period of time. And
so 2 years is the amount of time.
Yeah. All
right. Final question to wrap this up. We can now get 30-year amortizations. I think I always say that word wrong. How do you say amortization? Is it like amortization? Is there like an actual way of saying it?
Amortization. Yeah, that's right.
I feel like I've been told I say it wrong. Regardless, you know, okay, insured mortgage, new homes, 30 years, blah, 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 won't actually solve anything. When you first started doing mortgages, I'm sure were you giving out 40-year AMs?
I came in right before the longer AMs. It was all 25 when I came in. 25 was the maximum. And it went to 30. And we were like, oh my goodness. And then right away it went to 35. And we were like, oh my goodness, this unlocks homeownership for so many people. Then it went to 40. And then went 40 zero down, where you could buy with zero down. And it was wild. And so if you were buying, you could put almost like, if you bought under $500,000 home, so there's no transfer tax in BC, your only money you'd have out of pocket was like legals. It was bananas.
And those people got away with that because the market kept doing what the market did, and no one really got punished as hard as obviously what happened in the States. Now moving forward, we're at this weird point where it's like government says we want to keep housing prices reasonable. We don't want them to go up too much. We don't want them to go down too much. They've literally said this. But also, we need first-time home buyers can't qualify for anything right now because they're being stressed, as you mentioned, at 7.5% or whatever it is. Just going longer, I'm not saying it's a good idea. I'm just saying, like, to get votes, is it something that you think is going to open back up for maybe just only first-time home buyers? With this much down, you can get a 35-year AM on something? Or does that just create this ridiculous like circle of like, now the bubble's just getting bigger and the debt is bigger and those people shouldn't be approved for those loans, but then if they can't, how do they get home ownership? And then they have to rent. And Steve knows he's very opinionated on the rent versus home ownership. So I actually did some data coming into this one. And from Stats Canada, and this is only going up to 2019, so I actually like that because it's before the pandemic where things went crazy with prices. From 1999 to 2019, the average homeowner's net worth went from $323,000 to $685,000. Now that was a low interest rate real estate environment where things went up. In the same 10 years, the average net worth of a renter went from 16,000 to 24,000. So the reason why I'm saying this is not to say Steve is right. The reason that I'm saying this is because, like, well, if I can't get in and I'm stuck and I can't qualify because of all these other things, well, then I just go rent, and then maybe I get under rent control and I'm in a good situation, so I'm never going to get into the market. And I don't really know if this is a question. Maybe I'm just saying words here at this point.
Buy a house.
I know you were going to say that, but I wanted the answer from the guest. Like, here's the actual question, because I just went for way too long. Do AMs get pushed out at some point here? Is it possible for first-time homebuyers or something?
I think it's possible. I mean, the RBC is offering a 35-year AM on this new development because of this rule that's come out where first-time home buyers, and there's some criteria that they put into it. I wouldn't be surprised to see a longer AMs make a resurgence at some point in time. Yeah. That said, I think that they got to be careful to curtail that to, if you're going to truly try to help out the first-time home buyer, then it kind of should be for the first-time home buyer.
Right.
I know that'll piss off a lot of other people, but like, I don't see another way to help. If you're going to try to help the first-time home buyer and the young people, that's going to be one way to do it. Right. But I agree that buying the home and getting into real estate and getting in the property cycle is the only way of a standard, individual who's just going to make their payments. Personally, like, people would say, would you pick a 35-year AM? And my answer is generally, sure. I'd be happy to take one. Now, I want to pay my house off, so I'm going to make other arrangements to pay it down quicker.
Right.
But I liked the concept of having the minimum baseline payment lower that I could then accelerate and pay down. But only like 2% of Canadians use their prepayment privileges. The other 98 would just stretch their buying power and run the market up, right? Mm-hmm. That's the problem with the longer AM.
The problem.
So that brings me to, I'll wrap with this, because I started with a nice story about Rowan, because he's my go-to guy. I'm going to end with a nice story about Rowan, because he lined up my, and I'm going to tie in the middle here with this whole thing with, you can have a portion, like tiered mortgage. So I said to Rowan, I want a HELOC. I want the flexibility to do stuff with it. So we ended up putting, when I refinanced out of TD, I think, into Manulife, we put basically half on the fixed portion, half on the HELOC. And Rowan said to me, listen, one of two things is going to happen to you. He says, you have two things only that will happen if you have this HELOC. He says, one, you're going to run this thing up to infinity and max it out, and you're going to be angry, and you and your wife are going to be splitting up over debt. That's option one. Option two is you're the person that actually uses this correctly, and you're going to pay it down to like at an astronomically fast amount. And then you and your wife are going to fight about you wanting to pay down your mortgage and not spending any money on life. So I want you to know that you are absolutely correct, and I am in the second side.
But either way, you fight with your wife, just to be clear.
Yeah, that was the guarantee.
Okay. Yeah.
The guarantee is, you're going to argue with your wife, but it was about how much now. Like, when I look at that number, now it's zero now. I actually wish I could transfer more of my main mortgage onto that so I could just pay it down faster. And that will be happening. But it's just a matter of, that is, like, those are the two things. You're going to have somebody that takes advantage of every penny that they can get. And unfortunately, that's most people. And then you're going to have the people that use the tool correctly and actually use it in their advantage to pay less. And then we feel house poor the rest of the time, like I do right now.
But Steve, to give you a compliment for once, because I'm aware of this.
Bring it on, Tommy.
Right now, Steve owns multiple properties, and all of the mortgages on all of his properties are not being paid for by him.
Correct.
That's pretty damn cool. So
yeah, that's the way it's supposed to be.
All right.
Including principal residents. Yeah.
That's what I'm saying. Yeah, because the basement tenant basically pays your mortgage now.
Yep.
Yeah. Rowan, final thoughts, words of wisdom, anything for the people that watch this that you think would be helpful? Fixed or variable?
Anybody looking for to get their mortgage approved within 1.5 hours? How would you have them contact?
The thing I was thinking about when you told that story was, there's a joke amongst brokers that the first deal we always get from a realtor is either their own or a really challenging situation. And right, it's always
when you're trying out someone new. It's like, well, send them this one. See what.
Yes, send them this one. It's like, okay, we got to deliver on this one.
That's awesome. Well, thank you so much for joining us. It was great for me to get to meet you, and it makes sense why Steve has been working with you all these years. Steve, you got anything to wrap us up here?
No, I'm going to put Rowan's contact down below if you want to apply for a mortgage. He will not get it done in 2 hours, but he's he is my top guy. I recommend if you're going to reach out to my team, I'm going to tell you to talk to Rowan anyway. So awesome. We might as well just connect with him in the show notes.
Thank you, everybody, for watching and listening, and we will see you next week. Bye.
Bye.
All right.